Tuesday, June 20th, 2017, Monaco 64, home of alternative economics and contrarian views. So I'd like to talk about the stock market in relation to commodities or real things. And mainly because I've read a few articles, and I'm not going to review these articles, gonna use some aspects of it. The first article is from katusaresearch.com, and I'll put the link below, and it says the chart 45 years in the making, commodities versus S&P 500. So I'll show you the chart later, but basically, the S&P 500 hasn't been as expensive in relation to real things or commodities for 45 years, or maybe even more, almost 50 years, I would say. And I'm not saying that commodities are going to have a bull market and go up massively, because it's a relative measurement. But what you could have is a correction in the stock market, and you could have the commodities actually rise a bit, and that relationship would become more balanced. The other article is is on Zero Hedge. It's actually coming out of the FT is an opinionated op-ed by Mohammed El-Arian. He used to be quite high up at PIMCO. He was Bill Gross's second, right-hand man. I think he's running the place now. I'm not sure, but basically he's saying, El-Arian warns, says the article, the Fed no longer has your back. And he's actually asking whether the Fed is now worried about valuations of assets. And he comes up with a chart that I've used before, the US Macro Surprise Index versus the S&P. And you see this chart as well. The US Macro Surprise Index is compiled by Citibank or Citigroup. And basically, it's the how macroeconomic data from the US economy have performed in relation to expectations before they come out. So if CPI is expected 0.2 and comes out 0, the macro surprise index will be negative. And so right now it's like at minus 78.6, which is the lowest it's been in the last 2 years. I mean, you see it in the chart. So basically, yeah. So stock market's the most overvalued in 50 years almost versus real things. There's been, of course, a lot of talk. You can read an article a day about how stock markets are going to crash, not only in the alternative media, but in the mainstream media. But stocks keep going up. I did make a video about Lindsay Williams' talk and, with his elite friends, who said that we could see a melt up this summer in the stock market. I did the video about a month ago, and the stock market has kept going up. Maybe also people, investors, fund managers, they've got rules they have to follow. A lot of people don't know. For example, some pension funds or some mutual funds, they require managers to keep a weighting in stocks, a weighting in bonds, a weighting in commodities or cash. And if the stock market keeps going up, they need to make sure their weighting stays. So they have to keep buying, even though they think, it might be overvalued. That's the other thing. And what I wanted to say as well is that, a lot of people think, oh, the Fed and the, all the other central banks, they can keep printing money and buying things forever. But if that was true, we wouldn't have had crashes in the past. And, central banks are not omnipotent, I don't think. They've been able to keep things going since 2008. But, how long more can they do that? There's also, I spoke yesterday in my video about Fed, how can I say, members speaking. And you had New York Fed President Bill Dudley yesterday. He was quite hawkish. He said halting tightening cycle would now imperil economy. So I don't know what economy is looking at, because the US economy and the rest of the Western economies are not doing really that well. But these guys seem to live in an alternate reality. But then there's another Fed president, Evans from Chicago, who came out and he actually, and Zero Hedge reports, it says Evans flips from hawkish to dovish, says Fed could wait until December before next rate hike. So I don't know what's going on, but I think we need to focus on the markets and these relationships. The Fed can only influence markets. So first of all, let's have a look at this S&P commodity index versus the S&P 500 index. And you can see there it's been compiled, this chart compiled since 1970. So it's 47 years old, basically 50 years. And I don't think it was that much lower before 1970. So you can see that's the S&P commodity index. Look how low it is. It's below 1. It's never been that low in 47 years. You can see there the little green shades, the tech bubble in 99, 2000. That was another period when this, the commodities were undervalued. And look what happened, until 2008. We had a commodities boom. Gold price went from 250 to, 1921, or in 2008 it went up to just over 1,000. But and then you see that prior to the mid-90s that this relationship would only get down to around 3. It's been in the last 15, 17 years that they've, the Fed and all the other central banks seem to have driven this relationship a lot lower. So would you really want to be adding on to your basket of S&P 500 stocks and not really being exposed to the commodities or to gold and silver? I don't think so, looking at this chart. And the other thing as well, I saw yesterday reading something. If you take out the FANG stocks, the S&P 500 hasn't done really well. There's even a new name. They've added some more stocks, and it's called Fantasia. I think it's Facebook, Apple, Netflix, Tesla, and some other ones. And so now I'll show you the chart of this S&P versus the US Macro Surprise Index. And that came from the ETHEREUM FT editorial. And as you can see there, the US Macro Surprise Index compiled by Citibank, it's, how expectations are met when US macroeconomic data come out. When they come out lower than expected, the number is negative, so they add it up. And as you can see, it's the minus 78.6 is the lowest in this chart here since 2015. And look at where the S&P is. Either the U.S. economy is going to pick up massively, or we're going to see a correction in S&P. When is that going to happen? I mean, people always want to know when things are going to happen. I don't know. I mean, there's some psychoanalysts, they're talking about September and the end of the year. I guess that's always like, cyclically or, seasonally. We always tend to see stock market corrections or crashes in September, October, sometimes November. I don't know. But that's what I wanted to talk about. It's not even, about speculating or, of course, you can trade this, go long commodities and short the S&P. But to me, it just says that there's something, out of whack out there. Maybe the Fed is woken up and is saying, and maybe they look at that chart, the commodities versus S&P 500, and they're saying, we can't let this keep going. It's going to cause I think it's already going to cause a lot of problems once it does correct. But they're just trying to do damage limitation, in my opinion. And the other thing I wanted to say is that, for the last 8 years after the crisis in '08, central banks basically, they haven't helped the economy. They actually hurt the real economy and the average person. And that's why, the rich are getting richer, the top, because the central banks are actually just trying to keep the financial assets very high, but they're not improving the real economy. The way to have improved the real economy would have been to let the system actually collapse in '08, reset the monetary system, start from scratch, liquidate a lot of bad loans, but they didn't. They just tried to keep everything going. They threw everything at it. So we still got the problems that we had before '08, but now in spades. So I think next time there's a crisis, it will be terminal in terms of the present system. Hopefully central banks will be a thing of the past and will become extinct. We'll have to see. That's wishful thinking for my part. So yeah, if you enjoyed this video, give me a thumbs up, share it far and wide, subscribe to my channel if you haven't yet, watch my videos on Steemit, STEEMIT.com, and I'll talk to you later. Bye.